Expected interest rate cuts, inflation, recession risk, expected earnings. What does this mix hold for investors 2024? This is what I'm going to discuss with Felix Brill, the Chief Investment Officer of VP Bank. Felix, a quick look back. What did most surprise you 2023?
Well, I think it's interesting how 2023 turned out, kind of plain, even normal. At least if you look at the performance in financial markets, most asset classes posted a positive performance, some of those even in double-digit territory. And that was not a given throughout the year. Actually, there were some critical moments, for instance, the banking crisis early in 2023, or later in the year, then a kind of a second interest rate shock in the US, or the outbreak of the war in the Middle East. So against this backdrop, it is not only nice, but also to some extent surprising that this year 2023 turned out so normal, so plain, so positive.
Hopes of interest rate cuts have driven markets in the last quarter of 2023. Why would central banks cut rates so soon?
Well, to support the economy, plain and simple, because we've seen a bit of a decoupling. On the one hand side, we see positive sentiment in financial markets. On the other hand, we see negative sentiment, negative leading indicators in the real economy. Central banks would like to support the economy, and in order to do that, they would like to cut interest rates. And in recent weeks, end of 2023, we've seen more indication that they will be able to do that because inflation is coming down, and that is very positive for financial markets.
At the start of 2024, the investment committee still favors bonds over equities. How would interest rate cuts affect these two asset classes?
Well, at the moment, we're still speaking about expectations. And so we've seen that impact already, the positive impact on equity markets. Two factors. First, we've seen that basically the expectations for lower interest rates mean that we see a lower discount factor, meaning that future earnings will be worth more today, which is positive for the valuation of the companies. And the second factor being that the support by central banks for the economy would mean that earnings would improve, and that's also positive for equity markets. But here's the thing, this has to materialize. This is only expectations right now. And there are some obstacles along the road. For interest rates or for bonds, however, an actual rate cut is already positive. So therefore, we think the better place to be right now tactically is bonds and not equities.
Thank you, Felix. And that concludes our View the Questions. I hope you'll join us again next time. Goodbye.